Small investors are going to lose big on long-term bonds. Oh, wish I would have read this article before I invested in the Schwab U.S. government long-term bond ETF. Did not do my research, and apparently I'm going to pay big. Pay big. Ooh. All right, so let's read this, my friend. So here is a small investor likely loser on long-term bonds, according to Neil Leslie. I don't know who Neil Leslie is, but we'll read. A surefire way of losing money is by investing in long-term bonds during periods of high inflation. All right. The conventional theory, according to Dr. Benjamin Graham, of which his protege was Warren Buffett, is that you should invest a certain percentage of your portfolio in equities and the rest in bonds. Unfortunately, Graham overlooked the invisible losses that occur with long-term bonds resulting from inflation. Actually, there are 3 risks in purchasing a bond. Number 1 risk is financial. What's the likelihood of the bond paying you back? All right, this is credit quality. Will the bond go bankrupt before your maturity date? That's a financial risk. Well, if you invest in government bonds, that is not a risk. There's no financial risk with U.S. government bonds because it inherently cannot go bankrupt. So at least with my bond, the long-term government bond fund, I got rid of that. All right, so there's no financial risk. Risk number 2 is interest rate risk, all right, which are affected by current rates. The prices decline as interest rates go up, or prices increase as interest rates go down. So let's write this one down. All right, interest rate risk. Now, he should have done a corollary called, and I'm going to do 2A, called reinvestment risk. All right, and we'll get in that here in just a second. But there's a 2A for interest rate risk is reinvestment risk. And number 3, of course, is going to be inflation risk, which is what this guy is going to talk about. So we have basically 3.5 risks: financial, interest rate, reinvestment risk, and inflation. So let's see what you talk about inflation. All right. And inflation, which can be the most damaging of all the risks, especially as the small investor is concerned. All right. So to illustrate this, take a look at the cost of living over the last 31 years. Right after World War II, with the release of price controls, the index, the cost of living, shot up by 18.2% in 1946. The following year was still at 9%. All right. So, but then we're going to look at the 2 years after World War II when we had low inflation. In the 29-year period of time remaining, the nation's inflation rate averaged 3.23%. So basically, just like us, we're about 3% inflation. All right. However, in the years from 1948 to 1965, those basically 20 years, the inflation rate was actually 1.7%, not too shabby. It's the years from 1966 on where inflation began climbing. And so from the 1966 to 1977, inflation was at 5.6% a year. Yikes. So if you had plunked down $1,000 for a hypothetical bond yielding 2.5% at the end of 1947, you would have received, let's see, and selling at the same price in 1958. So you bought the bond, all right, in 1947, the end of 1947. If I can find hold on just a second. In 1948, the end of 1947, beginning of 1948, you bought the bond for $1,000. 10 years later, in 1958, the bond matured for $1,000. All right. So we got $1,000 back, but like my man says here, but if you factored in inflation, you would have lost 20% of your capital, your purchasing power, because of inflation, and thus your purchasing power would have been reduced to $800. So in real terms, you actually don't walk away with $1,000 in purchasing power; you walk away with $800. All right. So we have $1,000 is what we bought. We factor in 10 years, we get $1,000 back, but because of inflation at whatever he said the rate was, I think 2.5 or something like that, we're actually only having real purchasing power of $800 back. All right, so that's where inflation eats you alive. All right, since the interest rate, all right, let's see. But you did receive 242. I'm not sure I got 242. I'm just going to say 250 because we have a 10-year bond paying 2.5%. All right, 10-year bond paying 2.5%. So we did receive $250 of income over those 10 years because we got 2.5%. So we got $250 of income and interest. Now this is before taxes, by the way. All right. So $250 plus the $800 means we actually have $1,000.50 net of inflation. $1,000 and $1,000 and $1,050 net of inflation. So we made $50 on a 10-year bond, net of inflation. Now people are going to argue, but that $250 was subject to inflation too, and that's where we're going to. That's what's called reinvestment risk. We'll talk about that in just a second. So we based in 1948. We plopped down $1,000 after inflation in 1958. We got $1,050 back. So we made $50 over a 10-year time frame net of inflation. Not a great investment. I don't deny that. All right. Not a very good deal. And we're talking about taxable income. So this is before taxes too. All right, a glance at what happened during the inflationary time of 1966 to 1976. It gets worse. You bought a $1,000 bond at 5.75%. All right, after inflation, because we had inflation that ran, 5.7% or something like that a year. That $1,000 bond was only worth $524 after inflation. So in 1966, we bought a $1,000 bond. And in 1976, it matured for $1,000, was actually worth, 574, I think is what he said. Hold on a second. 524. All right, so here's what happened. $1,000. We bought the bond for 1966 and 1976, but actually in purchasing power, in real terms, it's only worth $425 or $424. However, because we were getting a coupon of 5.75, we made $57.50 a year, or $575.50 in interest. All right. So we actually made more money. We actually made $575 plus the $524 that we had in real purchasing power. So we walked away with $1,100. We started with $1,000. We walked away with $1,100 net of inflation. Not too shabby. So we actually made $100 over a course of 10 years. Not a great investment, but okay, still. And you can see right here. Let's see. We basically made no money over 11-year investment, what these guys are saying. I did, a little bit. You didn't make much. As noted before, the interest figures are merely an indication of long-term loss, showing clearly a declining rate the longer the bond is held. So we made no money. So that's interesting. So then what I did is I went to political calculations, and let's do that real quick. I said, what if we invested in the S&P 500 in 1966? So we're going to go to 1966, the beginning of 1966, the same time we invested in the bonds. In 1966, hold on just a second, right there. And we're going to put right there. We're going to invest in that, and we're going to mature it at the end of 1976. Or it'll be, well, I guess who knows what, so it doesn't matter. We're going to go to 1976. All right, so we're going to do it at the end of 1976. All right, so what did the S&P 500 do then? Oh, net of inflation, we actually lost 1% a year. And again, this is not subject to taxation either. So in 1966 and 1976, in the bond market, we actually made money net of inflation. In 1966 and 1976, in the stock market, we actually lost money net of inflation. Isn't that interesting? Now we can go back to 1948 if you want. And we can see the benefit of stocks. And this is what I'm going to show with you here. 1948, right there. And we're going to go to 1958. And we can cherry pick this until we're blue in the face. But I just want to use a comparison here. 1958. The end of 1958 is right there. All right. And remember, we basically made $50. Oh, but look at that. And from 1948 to 1958, the S&P 500 returned 16.4% a year, which means we've doubled our money, 72 divided by 16, every 4.5 years. So we had $1,000. We would have had 2,000 in 4.5 years, 4,000 in 9 years. So let's just say we had about $4,500. All right. So at the end of 1958, our stocks went from 1,000 to about 4,500. Our bond went from 1,000 to 1,050. All right. So in that case, the stocks did absolutely better than bonds from 1948 to 1958. 1966, on the other hand, our bonds went from 1,000 to 1,100, and stocks went from 1,000 to less than 1,000. I don't know what it would be, but still. All right. Which one's the inflationary times? Well, 1966 is the inflationary times. So you can't just look at it in a vacuum and say bonds are bad in inflation without saying, well, stocks did actually worse. And that's just a fact. Now, will that happen again? I have no clue. We don't have that many instances of high inflation in the U.S. We just don't. We don't have that much to look at. But we know stocks do well in low inflation. Deflation, bonds do well. That's not debatable. Anyone who debates about bonds and deflation doesn't know what they're talking about. So deflation, bonds do well. So let's draw this out. All right. And we have literally one instance of inflationary times in the U.S. of any significance. All right. So we got deflation, bonds for the win. Low inflation, stocks. High inflation, we don't know. But at a high inflation, we just saw bonds did better than stocks in the high inflationary times of 1966 to 1976. We'll do other videos from if you did like a 15-year bond in 1966 to 1981, because that's the beginning of the end of the inflation. But still, we know for a fact bonds did better than stocks in inflationary times from 1966 and 1976. That is not debatable. Stocks do better in low inflation. Bonds do better in deflation. So if we're going to high inflation, the assumption that long-term bonds are a loser, what do you say? What's the article say? Long-term bonds, what did I just do with it? All right here. Long-term bonds, well, I don't know about that. I don't know, because if we look at stocks, you say stocks are the loser according to history. All right, love to hear your thoughts. Put them in the comments. We'll see you.